He's an ex-portfolio manager at Morgan Stanley and is currently the founder and CEO of an investment platform called Kuvera, which I'm honestly a big fan of. I think he is a part of an extremely fast-growing startup in the fintech space, and is really being able to build an excellent platform for a huge number of people today in India who are looking at sort of DIY investing, which is do-it-yourself investing. Today we'll hear from Gaurav. He can help us understand passive investing from a lens of a fintech company, of at least an investment platform which is very popular amongst millennials and sort of the younger folks, and we'll be able to learn a lot from his experience so far. So over to you, Gaurav.
Thanks so much. First of all, thanks to Motilal, Oswal, and Pratik and Jatin for inviting us at this forum. I think we should have a lot more passive forums, and we should also have a lot more educational sessions so that people learn about passive investing. I'll also want to say that I'm glad I'm speaking after Pratik, because he's talked about a lot of concepts about on passive investing, on why it is cheaper, why on average the returns are better, and why investors should look at passive not just for domestic but also for global investing. So if you're watching this anytime in the future, make sure that you also watch Pratik's talk, because a lot of the concepts are similar, and believe me, we didn't discuss any of this before. So without further ado, I'm going to talk about passive investing in fintechs, and the way I'm structuring it is, if not us, who, and if not now, when. So is it the right time to think about passives, and will fintechs in one way or the other lead the charge towards passive investing? That's what I'm trying to kind of cover today. Yeah. Just a quick background on who we are. So I run Kuvera. Kuvera was the first free direct mutual fund investing platform. So we started back in 2017 when direct was still not as popular. We were probably the second or third direct plan investing platform, the first that got onto the BSE Star MF to allow investing into direct mutual funds. Since then, we have grown to about 1 million users now. We have 30,000 crores of asset under advice, and we process about 900 crores of mutual fund transactions every month, right? So we do understand a little bit about investor behavior. We do understand a little bit about what the young investors, what the new investors are looking for, what kind of solutions they're looking for. So I'm going to kind of also share some of that experience. Some of it is positive for passive, some of it is not as positive, but we can have a very fair discussion on that. And then if you have any questions, or if anyone has any questions, I'll be very happy to answer that, right? So coming into the big question, right? Is there anything about being a fintech that fintechs prefer passive funds ETFs? The question comes because of multiple reasons. I think globally, if you look at most fintechs, especially wealth techs, right? Starting from the wealth fronts all the way down to Moneybox in the UK, they tend to build their model portfolios around passive funds. They tend to promote low-cost passive investing. So is there something that kind of makes passive funds and ETFs preferable to fintechs like us, right? And we'll be looking at this from 4 different lenses, right? The first one is performance data. Are passives better for our users? Second is, where can we bring value to the table as an online platform, as a platform that is providing investment tools to our end users? Where is it that we bring the disproportionate value, right? Third is incentives. Is passive actually better for fintechs? And this is where we'll find out that not all fintechs adapt to passives equally quickly. And finally, how big is the opportunity, right? Like, where is the opportunity set for in passive funds for fintechs? And how do we believe that different fintechs, different wealth techs will play the passive opportunity in the next 2-3 years? Some of it has already started. We can discuss examples, but these are the 4 big points that I'm trying to cover today. Performance data, what's better for our users? So like I said, Pratik did cover this. There is, I think there's immense data right now that, I mean, I don't want to actually post the data, but doesn't matter which country you look at. It's almost a given that in across all market geographies, across all markets, whether it be emerging, whether it be developed, um, the average active fund finds it very hard to outperform a passive fund, right? In India, in large caps, over the last 10 years, this number can be as high as a 65, 70%. So about 70% of active funds have underperformed the Nifty 50 or a Nifty 100 benchmark in the last 10 years, right? Um, on top of that, the average active fund is more expensive than a passive fund. You can get a Nifty 50 fund for anywhere from 10 to 20 basis points. Even if you look at a Nifty Next 50, or if you look at a mid cap index or a small cap index, pretty much everything in a direct plan is available at 30 to 40 basis points range, while active funds in the same dimensions can go anywhere as high as 1.5%, right? So in a way, you can say that active funds is a place where you pay to kind of underperform. I mean, it's not exactly true. You pay because you want to outperform, but at least as the way the data has fallen out over the last actually a century of data in the US, almost 40 to 50 years in Europe, and 30 years in India, is that passive is a safer choice if you want to outperform over the long term. In 3 to 5 year period, anything can happen. But if you want to outperform over the long term, passive is a safer choice, and you pay a lower expense ratio, so you save on cost. So from our perspective, from the user's perspective, from the end user's perspective, as a fiduciary, we are an RIA. We should vote passive because it makes all the sense, right? Second is, where can we add value, right? As an online platform, we can provide a lot of tools to our end users. We can provide them with a lot of different ways to look at their portfolio, to look at their risks, and to be able to manage that risk over the life cycle of that investment, right? Now, there are two ways we can do that. One way to add value is that we can say, hey, you know what, we are really good at timing fund manager performance. And honestly, if you are really good at timing fund manager performance, then active will make sense, because in any given 3 to 5 year period, there will be a bunch of active funds that will outperform the index. It's just that as that time period keeps on increasing, that percentage keeps on falling, right? So, but in reality, what happens is that fund manager performance, timing it is incredibly hard. People have spent billions and billions of dollars trying to figure out, are there signals, are there different ways in which you can time a fund manager performance for an active fund, and mostly they have failed, right? Even if something works for 5 to 6 years, doesn't work for any sustainable period of time. So why does timing manager performance fail? Multiple reasons. Factor timing itself is hard. There is style drift. A manager might start out as a pure value manager, but then kind of start getting into growth if growth funds do well. There's manager rotation. What do you do when the manager leaves? There is closeted indexing. There's tons and tons of issues, all very well documented. On the other side is what also Pratik spoke about. We believe we can add value via passive asset allocation. Now, asset allocation, it's a simpler, more tractable way of saying that, through rebalancing alpha, through kind of advising the end users to be well diversified, through optimizing their taxes, and through reducing their expense ratios, we can add alpha at the portfolio level. We're not trying to add alpha at a fund level, right? The passive funds, by definition, won't have alpha, but at a portfolio level, you can add that alpha through rebalancing, diversification, tax optimization, and lower expense. So our strong belief is that for a robo-advisory model, or for a platform like ours that is providing all these tools to our end user, if we have a goal planning coupled with passive asset allocation, then we can drive more effective outcomes for our end users in terms of their retirement wealth, in terms of how much money they have for future healthcare, so on and so forth. So the third one, which is actually the key in every debate, is what is better for us as a fintech. What is better for us? Is passive better for us, or is active better for us, right? And incentives, incentives is like the two quotes that come to mind. One is Mind's law: where you stand depends on where you sit. And the second one, which happens to be my favorite, it is difficult to get a man to understand something when his salary depends upon his not understanding it, right? So incentives usually decide which wealth techs adapt or adopt passive more vociferously and more openly versus which continue to push for active through different kind of storytelling. I mean, if you can't use data, you can always use stories, right? You can always kind of build something to promote active investing, right? And the differentiation is clear. I think everyone here knows this. If it's a direct mutual fund platform, you're not getting any commissions from the AMC. Your end users are paying you. If you're a regular mutual fund platform, you earn a commission, and it so happens that active funds have a commissions which are 4 to 5 times higher than passive funds. So it's very hard if you look at from a pure incentive perspective. I'm not saying that incentive is everything. A regular mutual fund platform will also say that they want to do the best for their end users, because at the end of the day, if the user wins, you win. But in balance, their incentives are more aligned to active funds. So they will not adopt passive as vocally as a direct mutual fund platform. And we see that in practice as well. I mean, you know the names. I'm not going to name names here, but you know the names, and we see this exactly. We see this in practice. Uh, the final question is, how big is the opportunity? The opportunity, we believe, in passive is massive, right? India currently is at an asset split which is similar to the US in late 2000s, roughly about 20% or so of passives. About 20% of all assets are passive, out of which I think retail is much smaller. So the one differentiation between the US data is that retail passive participation in India is probably closer to the 98 2000 level, probably sub 5% right now. But if the US market is any indication, right? I mean, even if you look at the US market, the real growth in passive happened after the 2008 financial crisis. It was a crisis that people don't know exactly what happened. There was a crisis, a bunch of fintech platforms launched in the US. There was Wealthfront, there was a Betterment, and it kind of coincides really well with how passives took over, and now they are at parity in the US. Something similar is going to happen in India. Our strong belief is that something similar will happen in India, and passive can be a path. And this is where I think the debate thickens, and the arguments and the counter arguments thicken that. But we do believe that passives can be a path for a lot of fintechs to try and become an asset manager. It's already started happening. I think likes of Zerodha and Grow and a bunch of online platforms, investment platforms, have applied for an AMC license. And I would be very surprised if they launch anything except a passive only asset manager, right? And what they are looking at, is to try and capture this wave. So the best case scenario as a platform for us is that assets under management rise. So overall, the sum of assets plus passive rises, and passive share increases, wherein at least some wealth tech platforms will try and monetize by becoming asset managers, because in a direct plan platform, they may not be able to monetize it through any other channel. So our choice has been clear. About 60% of our model portfolio allocation has been in passives, and this has been true since launch. This is in 2017. We have also made discovery of passives easier. So, on our dashboard, you will see explore index funds. We want more people to find out about index funds, learn about index funds, at least see that there is a huge selection of index funds that is available today. So how are we doing, right? All of this, having a strong pro-passive kind of tilt and kind of making the discovery easier. Still, if we look at our own platform, only 1 in 5 most purchased fund on Kuvera is a passive fund. It's good, but it's not like, it's not like, oh, you tell people these are the benefits of passive. You might think, oh my God, these arguments are like undeniable. You should invest in passive, but habits take time to change. Investment habits take time to change. Investment stories, investment theories take time to change, right? So Today we are at 1 in 5. I would say we are doing okay. I won't say that we are doing great, but that's also the opportunity we have. So what gives, right? And this is kind of what I alluded to earlier. This is kind of what I think Prateek also mentioned in passing. If we look at the most watchlisted funds on Kuvera, there is almost a 65% correlation to the past 1 year, 3 year performance, right? So effectively, people are watchlisting funds that have done well in the past 1 year or 3 year, and this is true across wealth brackets. So this thought that wealthier investors are somehow more savvier does not reflect in the data, right? Even for the wealthiest user, that correlation holds true. And if you look at the past 1 year, 3 year performance, which funds will do the best? It will always be active funds, right? Because by definition, your passive fund is somewhere in the average. There are funds above, there are funds below. It's just that the funds that are above the average keep on switching every year or every 3 years or 5 years, and passive wins on consistency. So on a 10-year basis, passive funds look phenomenal, but on a 1 year, 3 year basis, they will rarely be in the highest performing funds, right? So that's the challenge that we are trying to solve for, and we believe that's a challenge that we are trying to solve for. And I just wanted to kind of show some more data that we did this study where we wanted to see that do past returns actually predict any future outperformance. So we looked at we looked at the past 5 year best performing funds, and then looked at their next 1 year of performance, right? So we look at a look back period of 5 years. We select the best performing funds, the top 10%. Then we see where do they fall in the next 1 year. It's all over the place. There is actually zero predictability on past performance, but that's what investors keep on doing all the time. This is the biggest fundamental behavioral issue that has to be in some sense overcome, either through storytelling or through data, for people to actually take on to passive, right? So so effectively, where are we, right? So from what I've been kind of, if you follow the entire thought process, our belief is that passive needs investor education at scale, and AMCs have to play a big role in this. What AMCs have done a great job. I mean, I'm talking from this purely from a perspective of a fintech, right? And also as an investor, my entire portfolio is passive, by the way. What AMCs have done a very good job of is they've added a lot of passive choices. What they've not done so well is they're not endorsing passives, even though a lot of their own data, even though a lot of their own analysis might suggest passives is better. And this could be because there is an incentive gridlock within the AMCs as well. There is an existing business, there are fund managers, there is a distribution business, and it's hard. So effectively, that is also, this second part is also opening up an opportunity for some of the fintechs or wealth techs to say that, hey, can we come in? Can we shake the status quo? Because we don't have fund managers, we don't have distributors, and can we own the passive story? So the big thought process as a fintech that we think of is, I think passive is here to stay, passive is going to grow. These are some of the things we all agree. The big question that I think everyone is now really debating is who is going to own the passive story, and what will be required to be able to own this passive story. I'll stop here, and if there are any questions, if there's anything I can answer, really happy to.
Great. Thanks, Gaurav. That was extremely informative and excellent insights from the lens of you and Kuvera. So we'll now move on to some Q&As which we've got from a YouTube channel. But before that, I just wanted to ask a question myself about what change you've seen over the last at least 3 years. So I can give you some context here. So when we launched our first, I would say, four or five funds, we had virtually no demand for them, and it was tough. And I went to a lot of wealth houses, a lot of I would say distributors, a lot of brokerage houses, but there just wasn't really demand. There wasn't as much education out there. In fact, the first I would say intermediaries who really picked up passive products were actually fintech platforms. Such as yours. So the whole reason to why at least I'm here is a large deal because of platforms like yours who have given a lot of education and advice to a lot of investors on passive investing. But compared to where things were about 3 years back, what have you seen in terms of shift from your customers, who've been around for the last 3 or 4 years time? Any insights that you could give us from how their behavior has changed?
Sure. See, 2017, when we first launched, when we first disclosed our first model portfolio, right? The biggest pushback was, why do you want us to invest in Nifty 50 and Nifty Next 50, right? The biggest pushback literally was indexing works in the US, India is not the US, emerging markets are different. This time, all the arguments that you hear about, indexing all the time, and people found it very hard to kind of appreciate that. The logic of why passives actually work over long durations, right? Even in our own data, right? I mean, we have 1 in 5 most bought fund is passive today. This has been true for about the past 1.5, 2 years. For the first 1 year, I think that the passive fund would have been in that, if I look at the top most bought funds month after month after month, the first passive fund would feature in the 11th or 12th position. So there has been a change. There has been a acceptance of passive. But I'll give a small caveat here, right? I'm not 100% sure that this acceptance of passive has happened because people are understanding the passive philosophy. Some of it has also happened because some very popular funds underperformed Nifty 50, and index itself did much better in the last 3 years. The Nifty 50 and the Nifty Next 50 has done, and I think some of that is being reflected in people saying that, oh, okay, you know what, actually index returns are not that bad. So we'll have to wait till a complete business cycle to kind of, come to a conclusion that, what, people are actually understanding passives in the way they should, like a, diversified asset allocation model, like you also mentioned, and they're investing in passives for the right reasons.
Got it. Great. So we have some questions from our audience. I'll start off with saying, I think, what you spoke about earlier is that, I think the last 3 years, the Nifty and Next 50 has done really well. But some people are asking, is that trend expected to reverse over the next 3 or 4 years time?
It's a fantastic question, and the question you have to ask is not that how Nifty 50 and Nifty Next 50 have done. The question that you have to ask is very different. Today, can you identify the manager that will sustainably outperform Nifty Next 50 in the next 4 years? There will always be a fund manager that will outperform the index. The right way to frame that question, because if someone comes to you and says, hey, you know what, in the next 4 years, I think three large cap funds will outperform Nifty 50. I'll say, yes, they will. But can you tell me today which those 3 funds will be? And because you cannot say which those 3 funds will be with any level of surety, index still is your highest expected return option, unless you're open to taking the risk of underperformance.
Got it. No, great. So the next question is to do with Kuvera. So so someone's asking, how would ideally rebalancing work on your platform, and what are the different types of rebalancing that people could do?
So we follow more of a goal-based approach. So we have an end-to-end goal-based solution where if you enter your goals, then we have this goal planning tool, which will kind of tell you what kind of asset allocation you should have. And if your asset allocation moves by more than 5% from where our model asset allocation is, we send you a notification. And the notification is basically along the lines that, hey, you know what, we don't have any power of attorney on anyone's asset, so we cannot auto rebalance anything. But our tool can help you send the right triggers at the right time. That, hey, you know what, at least compared to our model allocation, you're 5% off, and you should try and rebalance from either equity to debt or from debt to equity. The most interesting thing is that a lot of investors who have been with us, they find out that a lot of the model recommendations are actually very counterintuitive. They make perfect sense in the long run, right? But at the point in time, they're very counterintuitive. So last March, we are telling them sell debt and buy equity, while your own behavior would be. And just the fact that we send a message like that, even if someone does not implement it, a lot of times people come back and say that, hey, you know what, because you send me that you send me that nudge, at least I didn't sell my equity. At least I didn't de-risk any further. Maybe they didn't sell their debt and buy equity, which would have been the right thing to do, but at least they didn't sell more equity and kind of they went more into the hole as well, right? So it's always and completely goal based, because we find it very hard to be able to kind of think of any kind of an asset allocation without knowing what kind of purpose that money will be used for.
Got it. Great. So I'm getting a question. Do you have so there's someone in the audience who's 65, retired, and suppose they want to get a Kuvera and start their investing. What would you recommend them to do? Do you have a lot of users who are of that age group? And if you have, what do they end up doing, and what would you recommend?
Great. So unfortunately, we don't have a lot of users who are 50 plus, to be very honest. And I think this I can say with enough confidence is true for most wealth tech platforms. We do have quite a bit accounts which belong to elderly people, but they're usually managed by their kids, so they're managed accounts, right? 65. See, the thing is, right, once you're in the 60 to 70 age bracket, it becomes a little tricky, because what we don't know and what we as a wealth tech platform have difficulty finding out is, are you investing this because you need money for your remaining retirement years? Or are you investing this so that this corpus increases as a bequeathment to your kids? At that age, wealth level becomes very, very important. I'll give you a very simple example, right? If you are really, really well off, then there is no reason for you to become extra conservative at 65. In fact, you should now start investing based on your kids' life goals. Because a big percentage of that money is going to go to your kids. So for you to go into all debt thinking, because 100 minus 65 or whatever that asset allocation model, back of the envelope asset allocation, it's going to give you a mathematically correct answer, but it's not intuitive for the level of your wealth. So that's the population where we find it very hard. I mean, if someone emails us, we kind of give them the context that if you think you have enough saved for retirement, then you can take more risk. There is no reason just because you're 65, you can't take more risk. In fact, post 65, if you're wealthy, your risk should go up. But if you are kind of saving for yourself, then you of course have to be more conservative.
Got it. So last question for today. Before we wrap up your session, in terms of your platform, obviously most of the action today happens in the Nifty 50 and sort of next 50 type of funds. But what are you seeing about users adopting other funds across categories, say it's sector or mid cap, small cap, or international? Any insights out there?
So where we see the most traction is large cap, mid cap, small cap index funds, like you rightly said, and international funds. So in international also, I think within India, where we see most traction in index is S&P 500 and NASDAQ. People understand US. We use a lot of that technology. We use a lot of those products. Even though they are not Indian companies, they almost, the home bias applies because you're using their products day in and day out. Outside of these two, we find very little demand for index funds.
Got it.
That's where the meat is. Yeah.
Got it. Great. Thanks so much, Gaurav. This has been great. Thank you for your insights, and obviously, looking forward to more of these in the future as well.
Thanks, Prateek. Thanks for having me. Bye.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.